Hello and welcome back. I am Robert, and this is all about algorithmic trading. Over the past couple of weeks, I have been talking about various financial situations, such as the weakness in the Canadian dollar, and some of what I think could potentially happen if things continue at the rate they are going. I've also talked about my own personal finances in terms of my trading, and that's what we are going to talk about today. We are looking at my Euro USD account and all of my open positions. I have quite a few of them, but that being said, they have been reasonably profitable. The thing to understand about this process, though, is it is not a fast one. The kind of grid trading that I do is about stability and being able to weather the market through extremes. And as we can see for the last several weeks, we have been in a pretty strong ranged section. Whether or not we remain in that section, I don't know. But that's the point of why this strategy works. It works by looking at range, and range is always the entire asset. It's not going to be a money maker cash grab that people want it to be, and it shouldn't be. Oftentimes, grid trading fails because people get over leveraged. They open up too many positions when the market is too tightly compressed or compacted. To explain this more thoroughly, let's go down to the 1 minute chart. And let's back this off a little bit so we can try to see how I've arranged multiple positions. Alright, we might have to go up a little higher. I've actually got my spacing so far apart between my positions that it's not showing. So let's go to the 5 minute and see if I can get, nope, 15 minute, still can't do it. So this should tell you just how defensive I am with my ranges. Okay, finally the 1 hour. And you can see the gap between the two positions, which is roughly 20 pips. That doesn't seem like a lot, but when you're dealing with this kind of a market, it really is. It's a significant distance. And then when you factor in spread and volatility, that distance gets even bigger. But that's the point. This is why this technique works so well. It's not about a get in, get out, try to get the market perfectly timed approach. It's about a consistent, long-term approach. In fact, if you've read my Patreon or previous videos, or even been in the support server, you'll know that I have just finished a 1.5 years of testing with over 180,000 completed trades. 180,000 completed trades. 1.5 years worth of research, proving my grid trading technique is not only stable, but when set up properly, it is incredibly profitable. You see, as you look at your own trading and you document your own mistakes, you see that the biggest weakness in trading isn't the technique, it's you. You are your own worst enemy. You are your biggest problem. Now, this isn't about everything is always psychology, even though that is true to some degree, where you have to learn to control your own fears. A lot of it is far beyond just fear. A lot of it is understanding the asset you are trading, understanding exactly how it behaves normally, And one of the most critical parts of any asset is understanding its volume and liquidity. Can you get in or out of that asset quickly? That is absolutely critical. The other thing that often doesn't get talked about when you see profits coming in, for example, if we look at our trades on the side, we can see profits, 34 cents. We can see where we give back a little bit, so forth. But what isn't spoken about is what does it mean if you just walk away from the table? That is, all of the positions I am holding right now, if I was to sell everything, how bad would it hurt? Well, to be honest, pretty bad. Here is where I'm at right now with my accumulation cycle. If I walk away and just sell everything, I'm going to lose half my budget. I have $700 accumulated of Euro USD. Now, I'm not worried about that because of the style of trading I do, because of my risk management. And I also have the forced reduction stage where I slowly scalp positions off the bottom and sell them deliberately at the losses. That's what those fractional losses are in my activity log. So let's get back to the activity log and let's go back to the weekly. So on the chart down here at the very bottom, I am slowly ripping off piece by piece, 1 unit at a time for every profitable sell, which means I am forcing my whole grid to move. If we actually look at this chart, the yellow lines are where I had positions, where I had openings. And over time of actually running this, we can see on the chart that all of this area between my last position and my lower boundary line that I'd marked out, I have sold off. That may not seem like much, but when you do this constantly and routinely in the process of your trading, this reduction adds an extra layer of defensiveness to your risk mitigation techniques. You can't stop losses. They're going to happen no matter what you do. No one has a 100% success rate. But if you take your losses and you divide them across every profit, you drastically mitigate the circumstances by which your losses have an impact. That is, even when I have a loss, I still have a profit. So by doing this technique over and over, I avoid a hard loss where I gain no profit whatsoever. I avoid the situation where I just outright lose money. Now, it doesn't always work, and if the market just shoots up aggressively, it won't work. And if we go to the monthly chart and we actually look at a situation, we can see how this huge spike in the market can actually lead to that kind of situation if you don't have your budget planned out properly. And this is what destroys most grid trading. Most grid trading would be in this range here. It would drop down, which would shut it down, but then it would spike up and obliterate the entire grid, taking it out. By using the methodology I'm using, by letting my whole grid float, by using the highest and lowest of the entire market, and then figuring out my spacing from that, we can see that I have a huge amount of gappage. Right now, the lowest low is down here, and the highest high is way up here. I used this information to calculate my own risks. But this is how you actually build a proper grid to survive any market situation. You build it such that you are able to weather any kind of dynamic. You see, I have a calculated level where I know how many positions I can have. Worst case scenario, that is, I have my budget fixed. So my grid doesn't necessarily rely on just one range of prices, as in where I have my current positions. I can actually spread this out and cover a larger range. But by doing that, you increase the space between each position, and that increases the duration by which you are holding your positions. There are several ways of doing this, as I have demonstrated. Most commonly is just high minus low divided by your position count. For example, the often value I use is 100 individual positions. However, Oanda, the broker I am using, allows a single account to hold 1,000 positions. So by doing that, you can take your high minus your low, divide by 1,000, and that will give you a number that becomes your distance between your positions. You can mathematically calculate the exact duration of your grid so that no matter how bad the market goes, your grid is always functional. So if we look at this, we have high minus low, and that equals the spread of the market, the range from the high to the low. You then take the spread and divide it by your levels, how many positions you want to hold, and that gives you your distance. It's very simple and very effective, and it always works. Always. Because you're building a system that isn't bound to market pricing. It's bound to your budget. And that's the most important part of this whole situation. You are controlling your budget, not the price of the market. You are controlling what you can control. You are controlling what you can define. You're not trying to control the random chaos of millions of investors all doing their own thing. You see, this really goes back to a situation that has often been talked about. If you go back to the 1970s and early 80s, when the Bollinger Bands, the MACD, all of the traditional candlestick patterns that we are used to, they had a 70% win rate by themselves. Just straight up, slap them on the chart, follow them through, you are guaranteed reasonably well to have a 70% chance of winning any given trade. But that dynamic has changed over the years as more people have gotten into the market and more people have become competitive in how they profit from the market. People like me thinking about the market, using mathematics, and trying to find a way of being able to take advantage of those opportunities. Now, 50 some odd, 60 some odd years later, you have a circumstance in which computers and automation have made this even more of a battleground. So that now, realistically, indicators work, at best, only 35% of the time. And when I say indicators, I'm also talking about candlestick patterns in general, like the bearish engulfing or the bullish engulfing or your hammers or your dojis. Again, all of this was 70% successful in the 70s and 80s. Now, indicator to indicator processes are only about 35% successful. And this can actually be proven by running thousands of tests, which I have done. And sometimes it seems like my channels are slow, but these tests can take a long time. Like the 180,000 I did for my grid trading. That took a year and a half to complete that kind of testing to prove that my theory of grid trading is stable. And it is. That information is available on my Patreon. And if you want to help support that kind of research, please subscribe to the Jackrabbit TV tier for that situation. But as we progress, as you see the market, you must absolutely understand that you cannot control where price goes, but you can control how much money you put into it. That really is one of the biggest, most life-changing lessons I learned in my trading. Don't try to control the price. Control what you are willing to lose. If you do that, then you have a significantly higher chance of actually coming out profitable. And that is a major, major advantage. So let's zoom back into our small little window and discuss what we are looking at on the screen. Because it's interesting and fascinating. And at the same time, it is a situation that leads us to looking at the market in such a way that we can begin to realize the dynamics of what we are trading, of what other people are trading. And that, right there, understanding other people, is going to be your biggest advantage in your own trading. So as we look at the background, we see the blotches of red and green, the order book. The part that stands out is right here. Behind these bars, we see an enormous amount. Let's slide this over and redraw this. An enormous amount of positions at this price range. This is where a lot of people want the market to go back down to in order to begin to purchase again, to drive those purchases. So that is a circumstance by which we see. So these users are looking to capitalize on a very specific financial situation. But that helps us because it's in our range. This is a confirmation that we have found a good trading area. When we see that the order book is primarily below or within the sections we want. So all of this up here is below our upper boundary. There are a few things here in the top, but nothing to worry about overall. The most of our trading is within the yellow lines, and that is important. By using the order book to help us confirm our range, we can get understanding and information. That doesn't mean they're automatically going to become winners in our trades, but by putting probability and statistics on our side, we have a better chance. So if we scroll back a little bit and we zoom out, we can see up top that there are a few people with some positions way up here looking to profit. Whether or not the market will go up that high, that is going to be a difficult analogy because it's actually higher than one of the most previous sections. So this is not something we want to worry about right away, but it is something we need to be aware of. We already know that these trades here, that this section has been rejected because we never went above the level of what I have on the screen. And that is the important part. We have a good, solid rejection on the monthly chart that clearly describes exactly how the market felt about that price. So we know we have more information to support where we should be trading. Now that's not to say the market can't just dynamically change, because it can. But that is where your worst case scenario comes into play. That is where you think about what can happen. That is that spacing between your positions that we talked about, from the highest high to the lowest low, and then your maximum level of risk. All of that factors in to you being successful in the market. All of that factors in to you being able to survive. That really is what trading is about. And that is one of the biggest points that often leads people to losses. They focus too much on a tight range in the market, and they don't pay attention to other indicators, other bits of information that can give them a clearer picture on where they should be looking. So you want to use the order book. You want to use the price chart. You want to use the highest high and the lowest low. You want to be able to look at the market in a way that gives you a clear and unconditional metric. So as we look at the market, and I mean we look at the big market, all the way zoomed out, all the way at the highest time frame, we can see clearly where the market is at, where the participants want to be. That is where we need to look for trading. Not the little outliers, but real value. So as we look at the market, we can see up here there's little blotches. Those aren't going to go anywhere for a long time. Somebody's got places up there, they're holding on for an extended period, which is fine. That's just smart thinking on their part if they've got the kind of resources to wait it out. We see the upper level here that may or may not happen again. We see a couple of points where it touched in the long term, going all the way back to 2016. Again, somebody is playing a long-term game. They're looking at it and they're seeing opportunity. Nothing wrong with that. And we see where the market has been predominantly since roughly 2017. I'm going to say this is probably the cutoff point. So at least for 8 years, we have been predominantly within this range. That's pretty good, really. That is the way to find your anchor, to find the place you want to be. Once you see the data and you see where the participants are really wanting to be, then you have a good idea where you should be and how to capitalize on the market. Why is this area so important? Why is it so critical to understand where the market is? Well, it's just not about retail traders or individuals like you and I. This is about where banks, institutions, large financial companies, this is about where the currency itself has found a stable point. This is the Euro USD, two major economies. Between the European Union and the US dollar, you have a significant portion of money worldwide. So by understanding where that money is at, that balance between both currencies, that gives you a good bit of information to help you see how well to plan out your own success. As I said, you can't guarantee a profit, but you can turn the tables such that you give yourself better opportunities. And that's really what all this is about. Finding those opportunities. Finding out where you can get the best resources available. It's not an easy process, and it's taken me personally 6 years of work to get to this point. But once you're able to do it, hopefully not as long as it took me, but once you're able to do it, you're able to begin to see constant profits, consistent profits. And that's the point, consistency. It's not about how much you make. It's about how you are able to make it consistently over and over on a regular routine. Because if you continue that over the course of years, you are going to build a profitable portfolio. You base it on your budget. You base your budget on real life circumstances. And you plan. There's a saying that is often true. You plan the trade and then you trade the plan. That's what this has done. I've planned out my range by looking at the market, by seeing where the participants want to be. My plan is not to guess the prices, but simply to put multiple prices at a fixed distance apart. And then I trade the plan by buying and selling at those fixed distances. Does it always work out? No, not always. In fact, sometimes it just sits there and stares at you like an alien. But that's okay because it still works. But this is where liquidity and volume really matter. As we can see in the background of the order book, there's nothing here. This is a void, a desert. I might as well have planted a rose bush in the middle of Death Valley or the Sahara Desert. I might have actually had more luck. But it's all good because it still works. The plan is still working, even if the market isn't. This is, again, research. Look at where you are at. Look at what you expect the market to do. And we can see, despite some noise down here that is there for whatever reason, nobody up here at all. This is just a void of oblivion. The market wants to be here. This is all the market wants to be. And it hasn't budged in quite a while. Let's get to the end. As we can see, we have been stuck in this region since 2024. So 8-9 months of just sitting here going nowhere fast. But that's fine because the plan is working. The plan is automatic. As you can see from the green lines, I've actually put several take profits where I can just sit here and wait and let it happen. So this is an example where the plan is working, but the asset isn't. The British pound Australian dollar is a very slow currency, which is fine. The action is on the Euro USD. That's where the money is. That's where the traffic is. That's where everybody wants to be, where people want to buy and sell. That's where you're going to make your money in a high yield circumstance. So hopefully this behind the scenes of my thinking process has helped you understand exactly why I trade the way I do, what I gain out of my trading and by looking at these charts. MACDs, Bollinger Bands, RSIs, they work. Understanding how they work in today's market is different, but they still work. Understanding the value of thinking out of the box, that is where I think the market is going to go. I personally see indicators as a way of finding an entry point. Where can I get into the market? But then getting out of the market, that is a whole different story. And I prefer flat level take profit. 2%, 20 pips. Get out at specific levels and then get back in. Walk my profits slowly. I have it on the table, take it off the table, get a new position. And I slowly build my pot, as they say, by just slowly taking these profits off over time. At some point, I'm going to hit a saturation level. And that saturation level is going to be equal to what I've invested. So if you look at my current holdings, They're not necessarily impressive, but they're enough to make this enjoyable for me. This is my hobby. Rather than going out to bars or nightclubs or whatever, I like to trade. I like to watch the market. I like to see if I can build a program to outsmart the rest of the world. So far, I have managed to do decent. But as you can see from this chart, I don't have a lot at risk. This is really the best way to get into trading, with demo accounts, practice, and then eventually a small amount. It's actually very rewarding, very fun, and very relaxing. Share your thoughts though and let me know what you think. If you're trading, how is your trading going? Is it going well like mine? Or are you struggling? Are you having problems with the market, with planning your entries, with getting out with profits? Let me know. If you like this content, please give it a thumbs up. Please subscribe if you're not. If you want further content, more personal and direct content from me, please subscribe to my Patreon and help me continue to make this kind of content. Thank you for watching.